what it's like to run a REIT, understanding the roles and responsibilities of a REIT manager. They're the ones who are really the quarterbacks, you can say, behind a REIT. And then we got into structuring, and that is kind of a definition. What is a REIT about? Now, this phase is about what is the business strategy of a REIT? And I think we heard through the panel discussion, I think Raphael and Raghav particularly touched upon the conversation about a REIT is a large portfolio of real estate. A large portfolio of real estate. Now, the other addition point I'll make on there is that it's a large portfolio of real estate that has a target yield. So it's important that you have a yield that is attractive to your investor base. And at the end, at the base of the core of it really is what is the real estate portfolio. So this is sort of the essence of the business plan. And I would say that the business plan is something that is kind of part and parcel of the offering memorandum. It really is the strategy behind the REIT itself, how the REIT will grow, what is the size the REIT will grow to, what are the objectives of the REIT. And so this works to define a little bit about how you can articulate that. So those of us who are in the real estate sector here, we often deal with some of this work because we're always looking at, well, what is the angle? How are we going to make a return on an investment that we're going to make or a development that we're going to make? So it's similar to that, but now we have to operate as a portfolio of real estate, basically. So we've so far, the tool that we have has broken it down into these high-level considerations, and we've leaned upon some of the case study REITs we have in the incubator. And now when you see some of the definitions in this presentation, it doesn't necessarily mean that these are the only slides you would use. You would continue to expound upon some of this work and definitions to sort of really articulate a narrative and get into the details of the work. So initially when we talk about product definition, product here is what is the real estate product? What is it that you're talking about? Are you talking about housing? You're talking about industrial real estate? You're talking about commercial real estate? This is your product. Then your portfolio is basically a composition of your products. So it's many products. And so it's now the portfolio of real estate. Well, what is the size of that portfolio? How are you going to grow that portfolio? What are the nuances of that portfolio? Then you get into the REIT structuring. And we had a good panel just now talking about REIT structuring, about D-REIT, I-REIT, etc. Now, I think we've also heard that the D-REIT structure is something that's unique here in Kenya. REITs, as we normally consider them, are basically yielding vehicles, right? I think it was Raghav that touched upon, it's a very predictable check you're going to get. It's a predictable yield you're going to get. This is how we traditionally think about REITs, because you're looking for that regular high dividend payout. And REITs are particularly interesting because they are tax efficient payouts, basically. It's a tax wrapper around a portfolio of real estate. Then you get into the financial projections. So how do you project that your assets or your REITs are going to deliver that yield that you're looking at? And then who is the team behind it? And I think this is the last panel, and Peter Wacky talked quite a bit about who are the key actors in the REIT structuring process. It is a big team that delivers the operations of a REIT, and it's important to have the right team and the experienced team on board. So I'll go through each of these fairly quickly, and then of course there's always time for questions afterwards at lunch too. So product definition, this is now where we really look at what is the asset class you're going after? What are you focused on? And these slides here are going to talk about it from a housing perspective, but I'll try to touch upon it from also other perspectives like industrial or commercial real estate, even purpose-built student accommodation, as we heard earlier today, Acorn REIT. Early on in, the graph here on I guess it's your left, right? This looks at the income population. So there's a triangle and it says, okay, well, at different income levels, there's different housing types, right? So the bottom 20% we know is social housing. We go with the middle 60%, that's low income housing. Then we get to the upper, middle and high income housing, that is middle and high income housing. Now each of those segments has a different need. There's a different market, there's a different pricing, there's a different opportunity in the market. And coming back to REITs, it's always rental. REITs are always rental. So this is not housing for sale. This is not office space for sale. This is not industrial space for sale. This is industrial space for rent, housing for rent. REITs are always rental. So now, when you understand the current product landscape, you're trying to understand, well, where are the opportunities sitting? Is it in high-income rental housing? Is it in low-income rental housing? And then now the graph on the right-hand side you see, this is what we call income population. So this is at what percentage of the population earns what amount of income. Now, you can do this again for office space. We often classify office space as grade A, grade B, grade C. Each of the different grades of office space have different rental amounts. So for us here, you want to understand what are the different types of products that we have in the product landscape. Now I'll talk about industrial real estate. Industrial real estate, we have things like mini storage, we have logistics parks, we have even data centers you can classify under logistics. You have cold storage, which are specialized facilities. Each of these have a different need or requirement in our society, basically. And so you want to try to understand, well, what is the missing piece? What is missing and where is there an opportunity? So early on in, you're trying to define, well, what is the real estate product we believe we can take to scale, right? I think this is another point that was mentioned on the first panel, the REIT manager panel, is that REITs are really meant to be portfolios of real estate at scale. So it's not one building, it's not 5 buildings, it's not 10 buildings, we're talking about 30, 50, 100, 200 buildings in a portfolio of real estate. And so now you're trying to think, well, where is the opportunity within our REIT? So this is the first thing early on in. You want to get into the conversation about, okay, well, what are the different products? Where do the needs sit? The next thing within product definition as well, now we're starting to get more granular. So if we're talking about industrial real estate often is found in key nodes around industrial parks or along highways. Office spaces are often found within CBD districts or commercial districts, residential districts. Now, when you're thinking about institutional grade real estate, okay, so there's normally a requirement. I think Mr. Wayaki talked about eligible real estate. We're looking at institutional grade real estate within REITs. So you're trying to see, well, where is that real estate found? I think one of the big challenges that we heard today when Raghav was speaking, when they talked about student housing, is there wasn't institutional grade student housing available. You had to build it. Right? Similar for affordable housing, we cannot go and find too many buildings out there that have 300-400 units in it that is of good quality, having the amenities, having good quality finishes enough to attract good rents. So most often you have to build this institutional grade real estate. Now for the developers in the room and for people who operate in the property sector, you understand, judging on the neighborhood you're looking at, the land has a certain dynamic, the density of what you can build on that land has a certain dynamic, and your rental rate is different in each neighborhood. So we know that Muthaiga has a different rental rate and a development capacity than you might find in South Sea or in Ngara. So the key is what is the right nexus or intersection of those different factors that will allow you to build and rent your real estate at a market yield that will produce something that is attractive to your investors. This is the heart of REIT investment. If you can figure out that formula, you can start to understand where you can build in a consistent fashion, where you can build 10,000 units, 20,000 units over time. And the graph on the right here is basically market pricing, right? So as you're looking at different neighborhoods around the city, you're looking at saying, okay, well, this neighborhood, the land is okay, but I cannot build that much density. I can only build 1 times density or 1.5 times density. The infrastructure is not there yet. There's not enough interest in that neighborhood to justify uptake of rental housing. It's too far off a main road. These are all considerations that come down to why a certain neighborhood versus another neighborhood. So now I know that there's, when we looked at the composition of the room, I know we have a number of pension trustees, fund managers, lawyers, investment bankers. This is a lot of conversation around real estate. And I think as we continue to build this program up, we're going to continue now to bring together the real estate sectors and the capital markets, because at the heart of this work really is portfolios of real estate. So now let's say you've said, great, I'm going to do industrial, and I'm going to do industrial parks, or I'm going to do affordable and middle income housing, or I'm going to do grade A commercial real estate. Now you know your product. The next thing is to define and articulate what are the returns of those products, right? So now if you're saying I want to do grade A office, are you going to do grade A office in CBD that is 20, 30 stories? Or do you want to do boutique 3-4 story offices, maybe on nice parks that are there? if you're going to build affordable housing, are you going to build affordable housing in Angara that's 20, 30 stories? Or are you going to build it in Uthiru that is maybe 4 to 6 stories? All of these come down to your product type. That is what you're going to try to invest in as much as possible. Now, for those who are in the investment sectors here, I see Paul Kavuma was in private equity. I know a number of pension trustees and fund managers. You're always looking for investment parameters. And if you're a stock trader, you're looking at EV over EBITDA multiples. If you're trading in real estate, you're looking at cap rates. You're looking at what are the parameters by which I can say that this is something worth looking at deeper, something worth investing in. So you must set those parameters up. Because the challenge that we have for investors is not finding a good investment. There is so much land available. There is so many developments available. There are so many projects available. It's actually going through 100 different projects and picking the 2 that you invest in. This is where your project parameters are going to give you confidence. When you understand those project parameters and you break it down to 2, 3, 4 indicators, you have finally distilled the level of information that you understand the sector. You understand what is investment worthy. It is those factors that you need to explain to your fund managers and your pension trustees so they too understand what is your strategy. You can bring your strategy down to those key indicators and use them as a way to siphon out 100 different opportunities into the top 5, into the top 1 or 2 that you invest in. So this is how we now distill down into what is investment worthy, what is eligible real estate for the REIT. So now, by the time you do that, you're going to say, okay, great, I know what I'm going to invest in. So now it comes down to what is my portfolio size? Is this REIT going to be 10,000 residential units, 50,000 residential units, 500,000 residential units? Is it going to be focused on Nairobi? Is it going to be primary and secondary cities? Out of those, there's 2 parts. One is your portfolio strategy. So you'll likely come up and say, okay, well, industrial, I want to do logistics parks, but I also want to do mini storage. But what percentage? So you'll say, okay, I want my portfolio to be 60% logistics, 40% data centers. Or I want my residential real estate to be 80% low income, 20% middle income. So what you're going to do is you're going to come up with a portfolio strategy and you're going to come up with a portfolio sizing. This sizing is going to say, okay, well, in 10 years, I want to go to 40,000 units, 100 billion shillings. This is what my size of portfolio is going to be. The next question is how are you going to grow that portfolio over time? So you see the chart on the right starts to talk a bit about what is my growth? What is my portfolio development program? You have to have a program to give your investors confidence to say that today you're coming with one deal, but tomorrow you're going to come with another deal. Then there's going to be another deal. Because they are also looking for consistent investment products. You're actually doing the heavy lifting for some of the fund managers and trustees. You're saying, hey, this is worth investing in. So they will be your friend once you show a good product. But the key is to have repeatability in that so you can grow your portfolio over time. So this now comes down to what is your portfolio strategy? What is your portfolio growth? Then the next part gets into the structuring. So a lot of what we just heard now, to say, okay, now I understand my real estate strategy. That was my real estate strategy. How do we now root that into my REIT structure? Do I need a D-REIT? Do I need an I-REIT? Well, most likely you need 1 or 2. How am I going to acquire assets into my REIT? How am I going to pay for it? What are the legal documents that are going to bind me and those assets together? How am I going to pay for it? Who are my service providers? Et cetera, et cetera. So now this gets down to the structuring conversation within the REIT. Next, the financial projections. So you say, okay, great. Now I understand I want to build this portfolio of 30 commercial buildings or 100 industrial buildings, and this is how I want to do it over the next 15 years, and these are the cities I want to operate in, and these are the road networks I want to operate off of. What is the financial return of that portfolio? Is it a 10% yield? Is it a 12% yield? Is there a development return? What is the development return? How are you going to pay that out? What is that payout going to be? What is your asset management cost going to be, your overheads, vis-a-vis your portfolio income, right? And then this is where we come back to that question on the REIT manager panel. How do you protect your net asset value vis-a-vis your share price or your unit price? What is the level of transparency you're giving your investors? What is the clarity? And a lot of that is now defined within your financial models. Now, this is the design of the income REIT financial model we have in the toolkit, which starts at, basically for us, at let's say this is a residential model. At the most granular part of a residential model is one unit. One unit put together makes a building. Buildings put together makes a portfolio. So this is how we build it up, from renting of one unit all the way to the composition of an entire portfolio. And what is the return on that portfolio? Typically defined as your yield. Now, when we talk financial projections, people always want to understand what is the return. Basically, you can always break it down to a return. If you're talking income yielding, people want to know what is your yield. Today I put in 1 shilling, how much am I going to get back on a yield basis? How many shillings per unit am I going to get in my pocket at the end of the quarter? When you're talking from a development perspective, what is my IRR? What is my return on that risk that I'm taking? Now, there's 2 factors worth considering. First, on the left-hand side, what is your cost of capital? Now, in real estate, because it's asset heavy and capital intensive, you're always costing your capital, whether it be your debt cost, whether it be your equity cost. Now, your equity cost, because REITs are equity, your equity cost is always in relation to your risk-free rate, right? So now, today, earlier on, we were talking about the complexity of our risk-free rate. Today's real estate here does not yield as much as your risk-free rate. So in essence, none of us should be investing in real estate. But that doesn't make any sense. Real estate is a very sound investment. As we hear on the investment panel, it's an asset-backed investment. It is inflation protected. REITs are traded on the exchange, so you have governance, you have tradability, you have transparency. REITs are extremely good investments, particularly for pension funds, because they are long duration, pension insurance funds that have durations that they can predict, and therefore you can predict what is your level of duration you require. And it's better than holding fixed asset in real estate, because fixed asset is illiquid. You want to sell a building quickly, you're going to take a discount of 30-40%. You want to sell your REIT shares or your REIT units, you can do it at par value or NAV. So basically, it is a much more efficient mechanism to holding real estate asset. But you need to understand, what is your return vis-a-vis benchmark rates? And I like how Raghav had put it today, it's you gotta look like for like. Today you're holding a real estate asset directly, or you hold it through a REIT. What is the yield difference? Well, we know that REITs are tax efficient vehicles, so if you're a private investor, in theory you should be getting it at a higher yield. You want to sell that asset from quickly, what is the discount you're gonna take? This is your risk-based return. So understanding what is your risk and what is your return. These are the 2 main components, and how do they benchmark across the market. Now the other part of it is, what is your duration of investment? Now REITs are normally, you can say, medium to long duration. So people don't usually put it in to flip. You're not going to get a flip on a REIT. It doesn't make sense. You're going to put it in because you believe you're going to get a steady dividend out of that REIT. So basically people look at REIT investment in a medium-term duration, 5 to 10 years, or a longer-term duration, 10 to 30 years. So as you are doing your projections, it's important for you to articulate what is your return to that investment. Now, the thing is, a lot of the REITs we're talking about this phase of incubation in the market. Even the most established REITs in this market are still growing their portfolios. So your portfolio return is going to change over time. You need to be able to narrate that. Understand what is the drag your asset management fee has on your portfolio, and how are you going to then make that a more efficient asset management fee over time as you grow your portfolio. So these are the things where we talk about our projections. Now, we have a D-REIT model that is a little bit still in development in the toolkit. It's a little bit, sort of something that we're trying to figure out right now. The complexity with the D-REIT model, when you come down to having a single price per share, a D-REIT, you're constantly trading an asset in and out. So you are ebbing and flowing on your net asset value. So we're trying to figure out exactly how we model that. The current model we have right now is heavy on real estate development. So we understand real estate development models. It's like bringing that now to a portfolio of assets that trade in and out. So I'm hoping, Sam, to pick your brain a bit later on and see how we can build up our model here and have a good tool for the toolkit. So this is the financial models. The last slide here is on team and service providers. So I think this was kind of mentioned quite a bit during the structuring presentation. But basically having a strong internal team. Now when I say internal team, REITs are a funny thing, right? Like what is a REIT? REIT isn't really an entity. A REIT is sort of a binding, I think Peter put this really well, it's kind of a binding together of a trustee, a REIT manager, different consultants. But at the heart of a REIT is your REIT manager. They are the stars of the show. They're the ones who decide their growth strategy. They're the ones who go and fundraise. They're the ones who go and report. They're the ones who get the property manager. They're the ones who are basically running the REIT. So you need to have a strong REIT management team who has experienced track record in real estate, experienced track record in capital deployment, experienced track record in governance, because you want them, they're the ones you're entrusting with your capital. The second part of it is, who is your service provider team? This is also equally important. This is who are the experts that have worked on institutional grade real estate? This is key. There are a lot of MEP engineers and civil structural engineers and contractors out there. But institutional grade service providers, you can count on your hands. So you need to have the right auditors, the right accountants, the right engineers that are reviewing your work to make sure that you're getting the right level of reporting. So that was a bit on the business plan tool. Try to get through that as quickly as possible. Let me hand it over to Brian.
All right. I always get the honor of doing this right before lunch when everyone's energy is where it is. Can I ask that you put your hands like this? Everyone, just put it up. Thank you very much. Okay, you can put it down. This is meant to be a masterclass, so I will ask you to participate in this way. Every now and then I'll ask you to put your hands up. And then we will see whose hands will remain up, and we will look around. You'll see why we'll be doing this. So I'm going to go very quickly. I think Mr. Wayaki had talked about direct and indirect acquisition of real estate. So direct acquisition, everyone knows what this means, right? This is where you just go and you acquire property. So, hands time. Who has been involved in the transfer of a property? Whether it's for your family, whether it's as a lawyer, whether it's as a but you have been involved in the transfer itself. Okay, keep your hands up if that process concluded in less than 90 days. Okay? Okay, so the people whose hands are up, you finished this process in less than 90 days? Yeah, look around. Okay, so one hand, two. So one of the reasons why you do not purchase, or REITs do not purchase properties directly, is the time factor. You know how long it takes for you to go to Ministry of Lands, to do your stamp duty, to do all these things. A typical land transfer, even for an apartment, will take you 90 days, right? But where you're transferring shares, you'll go much faster. There is also the tax benefits, which I think we'll talk about. I don't know if there's any tax experts who are in the room, but you'll see. So one of the reasons why, a primary reason why you do this is because of how quick it is to transfer property. Now, indirectly, let's come here. When it comes to transferring property, there are a few rules which are unique to REITs, right? So the first is, in a REIT, you cannot acquire property where the trustee does not fully own that investee company. So for other industries, for example, if you're just a development company or you are a property holding company, you can decide to acquire 20% of the shares, right, in a property holding company. For REITs, the trustee cannot do that. It must be 100% of the ownership of that property holding entity. These are some of the things that are required, and I'm just going to go quickly. This is in the regulations. You need the engineer's report. I know there's been a lot of, if I can call it in the lingo of my time, shade thrown on D-REITs. But I have worked quite a lot with D-REITs. And I think there was a question that was asked earlier about the affordable housing. D-REITs are one of the solutions to that problem. You cannot solve that problem with IREITs, but D-REITs will help you with the construction. Once they finish, it becomes a problem for the IREITs. Can they get the yields that they want? You're doing affordable, you're doing 3 million, how much can you get? That's an issue for the IREITs. But for the D-REITs, when it comes to the construction, D-REITs are able to step into that gap. So you need your valuation report. Now, this is something that you will often have a conflict between the trustee's opinion, the REIT manager's opinion, and if you have any institutional investors or any large investors in your REIT. Why? Valuation is an expensive exercise. Do we have valuers in the room? Yeah? Oh, wow, you have no monopoly. Are you a valuer? Okay, or registered. Okay, diversified. So, valuation is an expensive process. The REIT regulations require that this valuation is done annually, but they also provide that you can do a desktop exercise. Now, if you're the REIT manager, you don't want to put up the costs of the REIT because it also has an impact on the financial performance of the REIT. It has an impact on the performance fee that you are paid. If you have to do this valuation every year, you will find that the cost of the REIT will keep going up. So what do you want to do? You want to tell the valuers, can you just do a desktop valuation? The property hasn't changed. The fundamentals haven't changed year on year. Yes, 3 years we can do a valuation, but year on year, can we do desktop? This is a potential area of conflict where whenever you have either an asset purchase or disposal, you'll have a difference of opinion on those 3 entities, and then you have to see who between the 3 is going to get through. Now, hands up if you are involved in any way with getting the CMA to approve or include LLPs as investee vehicles. Anyone in the room was involved in that conversation, whether as RAC, whether as NSE? Okay, so thanks to these individuals. When you look at the REIT regulations, what they talk about is an investee company. They say a REIT, when a REIT is acquiring indirectly, it can only acquire through an investee company. Now that means that all other corporate body status entities, like an LLP, which is a corporate body, cannot be an investee LLP. Now, that means that the tax thing that I had touched on, the tax benefit, if you do not use LLPs, there's an element of the tax benefits that you lose. So, thanks to the intervention of a number of you, yours truly also, CMA, which has always been very, very reactive, responsive, and supportive to the industry. Whenever we have gone to CMA, or RAC has gone to CMA and said, look, this doesn't work. This is what works for the market. CMA won't say, no, this is what the regulations say. So for example, earlier you were told when the amendment was done, it was done on the incorrect. So you won't go to CMA and say, I want to rely on this, but it is on the incorrect one, and they say, sorry, you must follow what it says. They listen to the practitioners. So why am I saying that LLPs are better than limited liability companies? Oh, it also permits you to acquire indirectly through investee trusts, which is not something we're not going to go into today because we don't have time. LLPs, just like the REIT, give you the tax transparency, right? So you have a REIT, so you already have the tax transparency principle. You can read a bit about this on you see the maroon? Zoravar, if you help me just lift that up. If you look at this, just pick it up outside. We've put some material on this. Thank you, Zoravar. A REIT is a tax transparent vehicle, right? It's like a chama. So it's not an entity itself. The person who gets the tax liability is when the distribution is given to the unit holder. Similarly, an LLP is a tax transparent vehicle. So the LLP itself passes on, once it gives the returns to the partners, it is the partners who bear that. So if you have the two, what are you doing? You're compounding your benefits. And I think the fundamental thing about making money is if you can compound a benefit, then that is very good for your investment. So LLPs, the other thing, it is a lot easier. Has anyone wound up a company in the room? No? All the companies that you've been involved in are going concerns. Okay. I can tell you the process of winding up a company is brutal. Okay? It's a very brutal process. It's a very lengthy process. It doesn't matter if you've sold all the assets of that company. We did a transaction years ago where we sold a company. It was just a butchery. The butchery is gone, but the company is still there. What do you do with it? Now, the process of closing it down for LLPs, you can do it in under a week. E-Citizen, if you have tried to set up a company, it can take you between a week, 10 days. An LLP, 3 days maximum, and you have it. So there's so many benefits of using the LLP entity for you to buy and sell properties as opposed to companies. These are some of the advantages. If you would like these slides rather than me going through them and then you look at me badly because you want to have lunch, we will email all these. Yeah? The flexibility we've talked about, the pass-through we've talked about, the ease of formation we have talked about. Now, what are the key things? Because this is also meant to be a masterclass. I want you to leave here knowing some things, whether you're going to tell your board, whether you're going to make the decision, and I'll go through some very quick bonus material for you when you're looking at these documents, and I'll go through some jargon that we use as lawyers, but for you to look through and see what exactly do you, whether you're a trustee, whether you're a property company, whether you're an investor in REITs, what exactly you want to look for in those entities or in those contracts. Financial DD. Now, REITs, as I said, very unique. There are a couple of regulations that say how REITs will hold those the properties, the leverage that they're allowed to have. So when it comes to acquiring a property indirectly, you have to do financial DD on the entity that holds the property itself. Yeah? So you're not just looking at the DD of the land itself. If it was a pure land transaction, you go to lands registry, you do your searches, you get your QSs. But for the property holding vehicle, you have to go and investigate the financial status of that entity itself. The other thing is now you go to the asset valuation. We talked about the expense of bringing in a valuer. Do you accept the book value? Do you get your own? What are the assumptions they have made when they were valuing the property? Then you've got your nuances on your legal and your regulatory compliance matters. For example, as I said, the fact that you have to own 100%. So what happens if you acquire 100% of the ordinary shares, but this company has a different class of shares? Is that permitted for REITs? Property-specific considerations. When you look at the REIT regulations, you will see, for example, when it comes to leases, there are also requirements as to the tenure of these leases that a REIT can own. And then the tax implications, again, this is one of the things that, whether it's CGT, stamp duty, I know there are a lot more conversations going on currently between the Treasury, RAC, and the participants in this industry on firming up some of the tax benefits that REITs have and expanding them a bit more, including expanding them to now include people who want to do affordable housing. Your risk assessment, you need to evaluate the risks of this. I think Zoravar has talked about, the risk parameters, whether it's geographical, whether it's your investment policies, and then very importantly, how you're going to exit. The exit strategy of D-REITs is very different from the exit strategy of I-REITs. Yeah? The D-REIT is simply, we want to finish and we sell. But is there a ready market for this? If you're doing the affordable housing, you will complete, very good. But at the end of it, is there someone who has an appetite to run this building that you've done for the returns that it's going to get? Management quality. Currently, I think we have 10 REIT managers who are authorized. I know that number is increasing. So that is another thing that you want to look at, because the REIT manager, your property managers will have to look through the quality of these assets which are coming in. And of course, the investment objectives that he talked about. This is one of the requirements of the regulations. You have to finish it. At least the regulations give you a bit more leeway. They say a typical transaction is 90 days. We're going to give you double that time. I can tell you there's not once, twice, or 3 times, multiple times we've had to ask CMA for extensions of this 180 days, which may look like it's a lot. But if we were simply doing, and where we have simply done indirect purchases, there's almost never need to ask for this extension. There are also requirements as to the amount of time upon which the REIT must invest, whether it's a D-REIT or an I-REIT, and then you've got the parameters there. I think we've talked about the DD, the title ownership, tax, property. So the discussion between, do you do an asset purchase, do you do a share purchase, will be informed by all these things that we have talked about. There's also, and this is now the key, especially if you're a financier, so for the banks or if you're going to look for financing, one thing that you have to know about REITs is you're constantly fundraising. I missed Raghav's presentation in the morning, but this used to be a key pain point when he was there. We were constantly fundraising. So you have to know the leverage ratios. When you're doing it, sometimes with the bank, they need to know what is your total asset value. They might then insist, again, have the property valued. Your costs keep going up, right? Because if I have to value for the transfer, I have to value for purposes of getting a loan, then that means every single year my costs keep going up. The regulations have a 6-month period, both for the I-REIT and the D-REIT, where they permit you to exceed, but only on a very temporary basis. When you read through these, you can see the intention of what the regulations are trying to do, to make sure that REITs do not lose the possession of the properties that they hold. That's why you have these gearing ratios as they are. So, post-acquisition, what are the key things? Transfer of legal titles, as I said, If you're doing this directly, then you have to go through this 90, 180, 200, 310 day process. But if you're doing it through transfer of assets, transfer of shares, then it's a much quicker process. Regulatory compliance, depending on the industry that the REIT is in, you may have more regulators than simply the CMA. So there are some where you have, whether it's IRA, whether you have, when it comes to the pensions. So that depending on that, that may then mean that when you're either divesting or investing, like I think Lab Trust was the last one that came in. So it's unique because you're not just looking at your primary regulator. You have a secondary regulator that you have to go to get some of these things. Financial management, I think we have talked about. I think you had a slide on these key clauses, so I won't go through them. These are the key things I want you to remember when you're looking through these agreements. A lot of times when you look through the agreements, there's a lot of ambiguity, or there's a clause which can be interpreted in a number of different ways. Where it's general, and I'll show you an example. You have conflicts and you have redundant clauses where it's just regurgitative. You keep seeing the same clause being repeated. Now, hands up if you think, when you just look at all the obligations there, okay, that's how they've been drafted. Hands up if you think the most stringent. So I want this one, whoever is reading this, I want them to know this is the highest standard. So who thinks telling them shall obtain tenants is the highest obligation that they have? Oh, now here it's a problem. Here hands won't go up because you're by yourself. Okay, who thinks using best efforts is reasonable efforts? Commercially reasonable efforts? Commercial efforts? Diligent? Good faith? Best? Good faith? Huh? That's legalist. Yeah, it means absolutely nothing. So, the consensus, yeah, that's all, between lawyers is that reasonable efforts, first of all, and best efforts. It is good to try and define what constitutes reasonable, what constitutes best efforts. Best efforts is the highest standard that you will have. But it doesn't mean that if you're supposed to use best efforts, you have to go out of your way to do things that were, for example now, for the REIT managers, to do things which are out of the scope. Our motto, our creed in our firm is going over and above. Best efforts doesn't mean going over and above. Okay? It doesn't mean that at all. Sometimes you say best and reasonable. So these are some of the ambiguities which you use both, thinking that you're taking it higher and higher, but essentially what you're doing is you're just cancelling out each other. Diligent, good faith, you're basically saying nothing. Okay, she talked about indemnification. This is a key thing that again and again, whether you're a trustee, whether you're a REIT manager, you will want to read the indemnification clause very carefully. Now, sometimes the reasons why you want to do this are listed there on the bottom. Have you read, you shall indemnify and hold harmless in contracts? What does that mean? Huh? You indemnify and you hold harmless. What the courts have said, some courts have said, is where you have a hold harmless clause. What you're saying is, you will not only indemnify, you will indemnify me as the, not any other third party, because I could have an obligation to another third party. Another third party could be claiming. So if you use the hold harmless, you're actually restricting yourself. So rather than use both, just say indemnify. I think I have some example clauses there. Then you have, in your indemnification clauses, you will talk about, whether it's general damages or your special damages. The rule of thumb is your special damage. So special damages, think punitive damages. General damages, think they flow naturally from the contract. So a special damage is something that, I think I was before the late Honorable Justice Havelock. And we had a claim for special damages a number of years ago. And then just before we submitted, the Court of Appeal delivered a ruling to say that you cannot get special damages for breach of contract. So you will see in your contract provisions where you've said, if we get, let me see if I have extracted. You see that sentence? Have you come across that sentence? Such damage, loss, injury as does not flow indirectly. You've seen this in a number of contracts, right? Mm-hmm. And it looks verbose, but at the end of the day, will you be able to claim this? So when you're reading this, try and see what what potential loss can you suffer? Because then it's easier to get your general damages when you're drafting this, or when the lawyers are, because sometimes the lawyers will involve the parties, and the parties will think the lawyers are just arguing between themselves. Notice clause. I have seen several contracts where the notice clause is left blank. Yeah? How many of you go through a notice clause and make sure you've put for the attention of either the CEO or the MD or this or that? This is a clause which we ignore a lot of times, but this is the clause that can cause you either to be able to get the benefit of that indemnity or to lose it in its entirety. How many have info at whatever your organization is? Do you have an email address for info at in your organization? Has anyone, the ones with your hands up, have you ever read any email from that info at? How many times have you seen in contracts, it says on the notice clause, info at? Now, when somebody sues, nobody read that. Sometimes you even realize who is the one who looks at the info at email. Do you know if it's the receptionist? Do you know if it's the admin? So you have to be careful about these things. And that brings me to the end. You can go for lunch now.